We're going to be talking about deal making. This is a really exciting space because I feel like we started off the year, and I was sitting having a conversation like this in Davos at the World Economic Forum right at the beginning of the year, and everyone was feeling really bulled up about the prospects for deal making, for M&A, for IPO activity in the US. And then you fast forward a couple of months, and obviously you had the tariff announcements, you had this massive wave of uncertainty unleashed. I think there was concern about what this all meant. We were entering into this new regime. And yet, in the last couple of months, what we have seen is public markets, US stock markets, all-time record high after all-time record high. And some mega deals have been closing. I mean, only yesterday, we're speaking about EA Sports. That is the largest LBO in history. We're talking about $55 billion here. So something has happened in the last couple of months, and we're going to get to the bottom of it. Anna, I want to start with you and just sort of, your description, your characterization of what has gone down in 2025 and why all of a sudden we're seeing these mega deals come to the forefront.
It's been a roller coaster ride.
Yeah.
Many of it unexpected. And now I think people getting comfortable with dealing with the unexpected. Every day you wake up and you're like, okay, what's the headline today? And how do you navigate it? And you can be at one level maybe concerned about that, but at a markets level, I think it's a good thing too, because the resilience that the markets have shown to absorb what each of these events that you could have viewed as a big shock and just kind of work through that. So I'll break it up into three buckets, right? First, M&A deal making, $3.4 trillion in the last 9 months. And historical average has been about $4 trillion. So even if you have $1 trillion, we are looking at 10% higher, but it's probably right now we are tracking to about 30% higher year over year. And this is after having a pause for about 4 weeks or so when it looked like, deal making was going to look very different. You talked about record highs in S&P and NASDAQ, but yet, Jenny just talked about it, the importance of scale, which is driving companies to do larger and larger deals. 49 mega deals, larger than 10 billion. 49, just in 9 months, contributing to about $1 trillion of volume, because the correlation between valuation and scale is at an all-time high. And so you see every strategic who's saying, yeah, if I want to do an M&A deal, how do I do a bigger and bigger deal? But yet, at the same time, there's about 20% of the S&P 500, which is trading at a discount, and a meaningful discount to their 52-week highs. So there's plenty of opportunities as well, which is why you see deals like these LBO deals happen.
Speaking about headline news, we walk in this morning, there's a US shutdown. Could that derail IPO activity? I mean, SEC is going to get impacted. Filings for IPOs are going to get impacted.
I think we could find, just among the four of us, 50 headlines this year, each of which in isolation you would have said should bring things to a grinding halt, because we are still in the middle of geopolitical tensions across the globe, each of which you could consider as a significant event that has an impact on many things in the economy. But yet, people have figured out a way to navigate it. So whether you want to call it uncomfortably comfortable, comfortable with uncertainty.
Numb.
Not numb. I think there's various versions of that. But no, I don't think it brings things to a grinding halt. I think the innovation, creativity, and most importantly, the need for scale, the need for supply chain solution, the need for technology, need for AI, the need to find solutions to labor. There's a lot of drivers such that companies don't have a choice but to navigate.
Okay, so let's pick up on that word scale. You are in the interest, Christina, of providing capital. The deals are getting bigger. I referenced EA Sports, but there are a whole bunch of other deals also. You talk about Anglo-Tech, the railroads in the US also. These are huge deals that are going through. How easy is it to get the capital that is needed to finance those deals? And how big can you go? I mean, 55 billion is a huge sum.
So the very good news is the credit markets across non-investment grade and investment grade are very strong, and we can talk about all-time tights, but importantly, supply-demand is still in a very good technical position, which means there's not a tremendous amount of supply yet of large transactions. Obviously, the deal you mentioned on Monday is a big one. And we've also had great innovation in the capital markets, and a lot of that happens in the US around the private credit markets. And the thing that's exciting for us at Goldman Sachs is the convergence of those two markets are creating even more pools of capital. And so when we created the Capital Solutions Group at the firm, that's what we saw. We saw private credit expanding. It started out in a non-investment grade sponsor-related market, and now it's grown into the investment grade market. This is trillions of dollars of capital that are forming to support these companies, these sponsors, these sovereign wealth funds, these large capital investments. The need for AI investing in data centers and compute and also energy transition, people quote $100 trillion by 2040. So we're quite confident that the markets will support that. Back to the question about how big can we go, right before that transaction announced, we held an internal session with our merger bankers, and we talked about the art of the possible for what would be a single BLBO, which is what that is, raising $20+ billion of debt, funding a large equity check. And I think it's really the equity there that is super exciting, which I know maybe we'll talk about. If you were going to expand that horizon to maybe a BB type credit rating, I think you're talking 65, $70 billion of transaction value could get done with strong credit markets across private and public. And then, of course, we have the equity to raise. But we're very, very optimistic about the return of large M&A, and we're starting to see signs of it. And we see it in the CEO boardrooms of confidence. And yes, the blip for the shutdown last night, I agree with Anu. Hopefully it's a blip. We've seen many of them in the past. They tend to be short-lived. I think the average is 8.5 days. That would be nice. But if it does drag on, I think ultimately you might see an impact.
Yeah. So May, I want to draw on your Middle East expertise. You've been in the region for a really long time. And
does that mean she's old?
I've been in the region for, I guess, a long time too. So we're all in this together. But not a day goes by where I'm not reporting on my show out in Dubai about a Middle East sovereign wealth fund that's taken a very large stake, a strategic stake in a U.S. company, whether it's in AI, whether it's QIA investing in Anthropic, whether it's MGX and Intel, the EA Sports deal, PIF, obviously a huge equity chunk. So talk to us about the role you think Mid East money plays in getting these deals over the line and how they are thinking about the investment opportunity with these strategic choices.
So I think if you go back historically, you'll see that the sovereign wealth funds used to be a passive investor. And passive investors in public securities or a passive investor in private equities, and they would not ever be on the forefront. If you look at just the past decade alone, past 5 years more specifically, but the past decade, that's evolved, that's changed. The sovereign wealth funds have realized that they have substantial amount of petrodollars that's coming into their coffers. And they have at the same time decided to diversify more meaningfully away from oil and gas domestically. So a lot of what you're seeing them do is really taking action for their own agenda and their own strategic agenda. So even if you look at EA as an example, and that transaction where there's a meaningful check, equity check that came out of PIF, that's part and parcel with their broader strategic plans of diversification, and sports and esports is a big part of that. Savvy was the subsidiary that was set up by PIF to focus on that. They've done an acquisition previously, Pokemon, and that was a $3.5 billion acquisition. And they continue to look at that as a means for them to diversify into what they want to be relevant in, which is sports, entertainment, e-gaming, etc. And a lot of what you're seeing them do is part and parcel with that mega strategy that they have. That's both in Saudi, which is a huge plan for them to go from what used to be a very focus on one center of gravity of productivity, which is the oil and gas, and now into a substantial amount of differentiation, which takes a lot of investment, and the investment can't be alone. So what they're doing is they're leaning in on partners. So even in EA, they had partners with them, partners that are trusting partners for them. They've done these types of investments for them to then, and we will see, I'm pretty sure, that there'll be a lot more of the development of these games happening back in Saudi as well.
But the Middle East capital is a slice of overall private capital, right? Because over the last decade, you've just seen the number of companies which stay private for longer and the number of public companies decline, right? So in that mix, I think this is the latest set of investors who have kind of grown in a meaningful way, but private capital itself has become a big part, whether that's private equity or private credit. That private capital continues to grow, and the number of companies who are staying private or going private and company formation in the private land is also increasing.
So you bring up an interesting point, which is specific to the PE industry, right? And the fact that monetization opportunities are less. They're just happening with less frequency. Many of these deals were done when interest rates were lower. There was abundant liquidity, back in 2021. It's a challenging time for the PE industry. How does that affect what you do?
So there's more creativity required for private equity to monetize.
Yeah.
And you start with the company wants to sell to a strategic, right? And the strategics are also looking at every portfolio company of every sponsor to try to find opportunities, because sometimes that may be an easier way for you to get something done. Plus, every flavor. It's no longer I take the company public or I sell the company. There is myriad variations of what you can do in between, partially own and partially monetize. And there's every color of the rainbow flavor in between. And that's what we are all doing, frankly. We set up a group to look at strategic financing solutions, which just means how do you look at the asset that you own and find a way to partially monetize and partially own. And why continue to do that? Because the multiples at which people enter these assets are still high, despite where the market is. That's one. And second, the scale that you need in order to go public. So I know here we are in London, but if you want to think about the S&P 500 inclusion, in 2008, the size of a company was $3 billion to be included. In 2024, $18 billion. That's a pretty dramatic change in scale that is needed, which means you need to get your company big enough before you become relevant in the market for index inclusion.
Yeah. I also think of functioning IPO market's a very important dynamic we should talk about, because that is, for a sponsor, an important element, particularly looking at these large transactions. When you're making this type of a bet on that size equity, are you committed to your IC to say, for sure, I will sell it to a private buyer 5 years forward, or do I need to make the commitment that I can take this company public again? And so, coming out of the gates of September, we had the best start in the equity capital markets since 2010. The ECM volumes now are up 18% year over year. Sponsor volumes are up. And importantly, the month of September was very active for sponsor IPOs, and they're all working and they're all trading well. And we actually at Goldman have 17 IPOs on the launch pad. So I do think, again, functioning markets across private and public are super important to support these transactions. And, that will be an important element for sponsors going forward to continue to be. A lot of them will stay private for longer, but there are some very large pending IPOs that sponsors are going to bring back to the public markets. So public market investors will have an opportunity to invest.
Well, I wanted to say also, May, I know you wanted to jump in, but capital markets also in the Middle East region have picked up significantly. We have seen a huge explosion on the IPO front. How is that also translating down the capital structure in terms of opportunities and PE interest in the region?
Absolutely. Can I just first maybe just address the one point, which is the other thing that we're seeing globally is the emergence of secondaries as another alternative to exits for private equity firms. And I think that is a wave that will continue for a while to come. And I think there's a lot of participants ever growing into that. So just
the continuation funds, I think,
entirely,
have
that's
also been
been
up about
the biggest and
40%.
something we're quite active in. But just going back to your question about the IPO markets and the capital markets in general, I have to say that in our region, the capital markets have been a little bit sleepy for a while, and then they woke up. Yeah. And they woke up with a vengeance. And the way that they woke up with a vengeance is through the governments of, in particular, UAE and Saudi Arabia, because I think these are the sort of more prominent of the capital markets. They figured out that the best way for them to support their capital markets is by privatizing their own companies, which are typically very well run, cash generative, dividend paying, et cetera. And I think they got to the realization that IPOing doesn't mean losing control. It just means monetizing and taking those funds so that you can actually invest them in other things that you need to, that are relevant to you, important to you, that you would have otherwise not necessarily been able to capitalize. So that's what's happened for the most part in UAE, in Abu Dhabi, in Dubai, in Saudi Arabia. And that really generated a lot of global interest in those capital markets. If you look at in the UAE alone, the markets are up 165% over the past few years. They've outperformed most other, if not all other markets recently. Tadawul has actually performed relatively well, maybe not as
Not so much this year.
Sorry?
Not so much this year, Tadawul.
Not so much this year, but Bloomberg wrote that perhaps there's going to be an easing off of foreign restrictions on trading. Yeah. I think that's a technicality that once that actually does materialize, I think we'll see those markets performing a lot better. Yeah. And I also think that people are looking for ways to invest that are outside of the core markets of the US, which some people think is a bit toppy. Yeah. So this becomes a good alternative as well.
I know, I want to bring it back to, I guess, the number one theme that's going to come up on every single one of these panels, and that's just the amount of excitement there is around artificial intelligence and the investment opportunities there. But it's not just excitement, it's actual hundreds of billions of dollars of CapEx spending is going into building out these data centers. Loads of deals are going through. Should we be nervous about valuations in this space?
There is not a single boardroom, not a single C-suite, not a single investment committee where AI is not discussed, not one. Every company you can, maybe it's like from 20 years ago where you said, oh, can the internet disintermediate the company? For every business, you have no choice but to take a look at what is going to be the impact of AI on this business. Mm-hmm. And for the smarter companies, and that's certainly what we're advising people to do, think about not waiting for somebody to come and disrupt you, but how you yourself can become AI-enabled and disrupt. So it is like, if you think about it as a choice, I think that itself is a problem because you have no choice. It's here, it's coming at every company, and so you have to evaluate it. You have to consider it, and you have to think about, do I invest and build, or do I buy the capability? While there is enormous amount of money that is going into AI, we are talking about AI as one homogeneous piece. There's multiple subsets to that, right? There's the data center, there's the digital infrastructure, there is what are you using this for, which type of AI is it? Is it agentic AI, is it machine learning, is it something that is predictive? So there is various versions of that, and there are some versions of that which actually generate immediate returns. I mean, we are running 200 LLM suites in our company at JP Morgan, right? And just with that, you see an increase in productivity. You see the increase in the amount of things that you can do with the same number of people, and the reach that you can have using the consumer insights from the Chase card side of the business at a scale level. So I'm actually super excited about the possibilities of AI. I know it's an overused word, and a lot of times people talk about it without fully understanding all the dimensions of it. But there's elements of AI which are actually pretty basic, and then there is the super evolved parts of it as well. But no matter which part of it, there's no company, no business that can afford to not invest, discuss, think about it.
Yeah. Christina, I want to come back maybe to the valuation question, which is where we started off the conversation, talking about public equities, U.S., all-time highs, even public credit, close to historical all-time heights, tights in some of these IG markets. Mm-hmm. And you continue to see this credit compression, but it's also happening in private equity and private credit as well. There has been a massive compression of spreads. And there are a few people out there who are beginning to say valuations there really are beginning to look toppish. How are you thinking about valuations specifically on the private side of things?
Well, I agree with you. Things have compressed. And so the public markets were near all-time tights, and below investment-grade private credit, we've seen spreads compress. We've seen terms become more aggressive. And so that is obviously an indication of, again, a supply-demand imbalance. But why we're comfortable, and I think from a macro perspective, we're still quite comfortable, is if you look at the macro data that's coming out still, you basically have an easing cycle. So the data suggests that the economy is weak, but not too weak. So there's still a fundamental underpinning of growth expected. And this U.S. economy has been remarkably resilient, probably more resilient than many of us would have expected with some of the bumps it's had. And then the growth that we're seeing also in Europe and in the Middle East and even in Japan. So while, yes, credit is tight, and it could cause you to really pause on investing in credit, there are some macro fundamentals that would suggest it's still a good place to put your money. And the other element of AI, which I think is super interesting from a credit perspective, is what's going on in energy transition. So all these data centers need a lot of power. And power historically has been an infra play. And the investments we're seeing in this country and other parts of the world create really compelling investment opportunities for credit investors. They're highly structured, they're contracted with investment grade counterparties. The structures are very resilient. And so again, it's an AI derivative, an element of AI that I think is very exciting and also safe.
Yeah.
Safer.
So where do you see the most value in that space?
I think it's some of these sort of greenfield projects. We announced the financing last week in LNG, and we use this sort of off-balance sheet structured equity technology that we developed in our capital solutions group, where $7 billion of equity capital was provided by our own asset and wealth management team, Blackstone, KKR, and Apollo, again, to finance a company that was concerned about its credit rating off balance sheet to do a greenfield investment in a really important project. So, and that's, one of our pipeline of many.
Yeah. May I want to end this with you. We often, most of the world, we associate Mideast money with money going abroad. And we've spoken about the sovereign wealth funds investing abroad. But increasingly, you are seeing more interest to invest in the Gulf region. This morning, woke up and read an article about KKR investing in ADNOC's pipelines, right? And this is a daily occurrence. Yeah. Why do you think this is happening more and more?
I think it's twofold. Number one, it is the sovereign wealth funds who have been very active, proactive LP investors in the private equity firms saying, we will continue to be supporters, but look at our own ecosystem, our own environment, and think about helping us because we want the best to be here. They want the best to help us invest and diversify and get the capital. KKR, this is its second go around with ADNOC. They did in 2019, along with BlackRock. They invested together in the first ADNOC pipeline transaction, and that did very well for them, and that was bought out off of them last year. So they're now back again doing the same thing. BlackRock again also did a similar transaction, $15.5 billion with Aramco last year. So we're seeing a lot more of the private equity firms coming in and deploying capital in infrastructure and infrastructure related. That's in one area. But the part that excites me a lot as well is the amount of investments that private equity firms are doing in private sector companies as well. So Property Finder just recently did a $525 million transaction. Primera came in and took a stake out of General Atlantic. And you're seeing more and more of the KKRs and the Carlyles and the Blackstones and the TVGs and GAs and the Brookfields of this world coming in and doing quite a lot of investments in the region across a multitude of different sectors, which to me is quite exciting because it just shows us that we are becoming important and relevant, even from a private equity standpoint in terms of looking at deploying their capital.